Do you want to make your money work for you instead of it just sitting in a bank account? Investing is the key to growing your wealth. But with so many options like stocks, real estate, gold, bonds, ETFs, and the list goes on, it's easy to feel pretty overwhelmed. So how do you know where to start? What's the best investment for your goals? The truth is, there is no one-size-fits-all answer, but understanding your options is the first step to making smart financial decisions. In this video, I'm going to break down the most popular ways to invest your money. We'll cover what they are, how they work, and the pros and cons of each, so you can decide what fits your financial goals best. So whether you're looking for long-term growth, steady income, or just a safe place to store your wealth, there's an investment strategy for you. So stick around to the end, and I'll even share some tips on how to build a diversified portfolio that works for you. Hi, I'm Greg Hardy, and welcome to the channel where we talk about all things personal finance, investing, and building a financially secure future. So if you're serious about taking control of your finances, learning something new every week, make sure to like this video and subscribe. One click helps grow this community and gets this knowledge out to more people who need it. Thank you. Let's first talk about stocks, because stocks are one of the most well-known ways to invest your money. When you buy a stock, you're purchasing a small piece of that company, making you a shareholder. This means that you own a fraction of that business, and as the company grows, so does the potential value of your investment. Stocks are traded on exchanges like the New York Stock Exchange and the NASDAQ, where investors buy and sell shares daily. There are two primary ways to make money with stocks: price appreciation and dividends. Price appreciation happens when the stock's value increases over time, allowing you to sell it for more than what you paid for it. Dividends, on the other hand, are payments that some companies give their shareholders as a share of their profits. Not all stocks pay dividends, but those that do can provide a steady income stream in addition to potential growth. One of the biggest advantages of investing in stocks is their high growth potential. Historically, the stock market has provided pretty strong returns over the long run, outperforming many other types of investments. Plus, getting started is easier than ever, thanks to online brokerage accounts that let you buy shares with just a few clicks of a button. You don't need to be a millionaire to invest. Many platforms even allow you to purchase fractional shares, meaning that you can own a piece of expensive stocks like Amazon or Tesla with just a small amount of money. However, stocks do also come with risks. Prices can be volatile, meaning that they can rise and fall quickly based on a company's performance, economic conditions, or even investor emotions. This makes stock investing riskier than safer assets like bonds or savings accounts. To be successful, though, it's important to do your research, diversify your investments, and have a long-term mindset. For example, take Apple. In the early 2000s, Apple stock was trading at just a few dollars per share. Fast forward to today, and its value has skyrocketed, making early investors significant profits. However, there were also periods of decline and uncertainty along the way. This is why patience and research are crucial when investing in stocks. While they offer high potential rewards, they also require careful decision-making to navigate the ups and downs of the market. Bonds, on the other hand, are a more stable investment option compared to stocks. When you buy a bond, you're essentially lending money to a government, corporation, or a municipality in exchange for regular interest payments over a set period. At the end of that period, known as the bond's maturity date, you get back the full amount you initially invested. Bonds are often considered a safer investment because they provide steady, predictable income, making them popular among conservative investors or those that are nearing retirement. One of the main advantages of bonds is their lower risks compared to stocks. Since they pay interest at regular intervals, they can provide a reliable income stream regardless of market fluctuations. However, bonds typically offer lower returns than stocks do, meaning they may not grow your wealth as quickly over time. Additionally, inflation can erode the value of your fixed interest payments, making them less appealing in high inflation environments. A common example of a safe bond investment is the U.S. Treasury bonds, which are backed by the U.S. government. While they won't make you rich overnight, they are one of the most secure ways to preserve and to grow your money with minimal risk. ETFs, or exchange-traded funds, and mutual funds are a great option for investors who want diversification without having to pick individual stocks. An ETF is a basket of stocks, bonds, or other assets that trades on the stock exchange just like a regular stock. This means that you can buy and sell ETFs throughout the trading day at market prices. Mutual funds, on the other hand, are professionally managed pools of investments that allow investors to contribute money, which fund managers then use to buy a mix of assets. So, unlike ETFs, mutual funds are only priced once per day after the market closes. One of the biggest advantages of both ETFs and mutual funds is their diversification. Instead of putting all your money into one company, you're spreading your risk across multiple assets. For example, an S&P 500 ETF like SPY or SPLG lets you own a small piece of 500 of the largest U.S. companies, reducing the risk that any single stock will significantly impact your investment. This makes ETFs and mutual funds a great choice for beginners or anyone who wants a more balanced investment approach. However, there are some downsides to consider. Mutual funds often come with higher fees because they are actively managed by professionals, which can then in turn eat into your returns over time. ETFs generally have lower fees, but since they track an index rather than being actively managed, you have less control over the specific stocks that are included. Some investors prefer picking individual stocks for higher potential gains, but that also comes with higher risk. Overall, ETFs and mutual funds provide an easy way to invest in a broad range of assets without needing deep market knowledge. If you're looking for a simple, lower risk way to grow your money, these funds are a solid option. Many long-term investors use ETFs and mutual funds as the foundation of their portfolios, myself included, helping them to build wealth steadily over time. Now, index funds are a type of ETF or mutual fund that track a specific market index, such as the S&P 500. Instead of trying to beat the market by picking individual stocks, index funds simply mirror the performance of a broad group of companies. This passive investing approach keeps costs low since there's no active management, making it a great option for long-term investors who want steady growth without the hassle of picking stocks. One of the biggest advantages of index funds is their diversification and low fees. By investing in an S&P 500 index fund such as VOO or FXAIX, for example, you're instantly spreading your money across 500 of the largest U.S. companies. This reduces risk compared to buying individual stocks, while still offering solid long-term returns. However, because index funds only match the market's performance, they don't offer the rapid gains that some individual stocks might. Still, legendary investor Warren Buffett has repeatedly recommended S&P 500 index funds as the best investment for most people.
And that is to consistently buy an S&P 500 low-cost index fund. Keep buying it through thick and thin, and especially through thin.
REITs, also known as real estate investment trusts, allow you to invest in real estate without the hassle of buying, managing, or maintaining physical properties. These companies own and operate income-producing real estate, such as malls, apartment complexes, office buildings, and warehouses. As an investor, you can buy shares of a REIT just like you would a stock, and in return, you receive a portion of the rental income in the form of dividends. This makes REITs a great way to earn passive income while diversifying your portfolio with real estate exposure. One of the biggest benefits of a REIT is their ability to generate consistent income, as they are legally required to distribute at least 90% of their taxable income to shareholders. However, REITs can be sensitive to interest rates. When interest rates rise, borrowing costs increase, which can then impact their profitability. Additionally, like stocks, REITs are subject to market fluctuations, meaning their value can rise and fall over time. Still though, for investors looking for a hands-off way to invest in real estate, REITs provide a solid opportunity to benefit from the real estate market without the headaches of being a landlord. Precious metals like gold and silver have been used as stores of value for centuries, making them a popular hedge against inflation and economic uncertainty. Now, unlike stocks or bonds, these are tangible assets that tend to hold their value when financial markets are unstable. Investors can buy physical gold and silver in the forms of bars or coins, or they can invest through exchange-traded funds like GLD for gold or SLV for silver. These ETFs allow investors to gain exposure to precious metals without the hassle of storing physical bullion. One of the biggest advantages of gold and silver is that they act as a safe haven during market downturns. For example, gold prices spiked during the 2008 financial crisis and again in 2020 when COVID-19 created economic uncertainty. However, precious metals don't generate passive income like dividends or interest does, and their prices can be pretty volatile. So, while gold and silver can be useful for diversification, relying too heavily on them can limit growth opportunities. Still though, for those of you looking to protect your wealth, holding some precious metals can be a smart long-term strategy. When you're ready to start investing, choosing the right platform is essential. Online brokerages like Vanguard, Charles Schwab, Fidelity, and Robinhood provide easy access to a variety of investment options, including stocks, bonds, and ETFs, with low fees and user-friendly interfaces. These platforms cater to both beginners and experienced investors, allowing you to start with small amounts of money. Investing is one of the best ways to grow your wealth over time, but finding the right strategy for your financial goals can be pretty overwhelming. So whether you're looking for high growth through stocks, steady income from bonds, or diversification with ETFs and mutual funds, there are many options to consider. The key is understanding how each investment works and aligning it with what your goals are, whether that's long-term growth, stable income, or a mixture of both. Starting small and gradually diversifying your portfolio is going to help you manage risk while taking advantage of potential opportunities. Ultimately, investing is a journey, not a destination. The most important thing is to begin. Start with what you're comfortable with and learn as you go. You don't have to be an expert to get started, but having a clear understanding of the options available to you is going to make the process much easier. So take the time to do your research, build a diversified portfolio, and remember that patience is key. Now, over time, your investments can work for you, helping you to build the financial future that you desire. Now, I ask that if you found this video eye-opening, don't keep it to yourself. Share it with someone who you think might need to hear it. And if you want more practical, no-nonsense advice on building wealth and securing your financial future, check out this video right here. And also, make sure to subscribe. Thank y'all so much for watching. I'll see you in the next one.